Let's talk to Marc Ostwald. He's a strategist at ADMISI, according to my notes. Morning to you, young Marc.
Good morning.
Right, so we've got two thoughts-provoking charts. Without further ado, let's go straight to the first one. US unemployment rate versus the underemployment rate. This is an interesting narrative.
Yes, I mean, we've got the US labour data today, and it's one of those which is, as ever, always pumped up as this is a crucial moment. Labour data in the US actually over the past 6 to 12 months have not really had the sort of market impact that they have historically.
Right.
And partly that's because the payrolls component isn't really the bit that we're looking at. But for what it's worth, we're looking at 200,000. I think all the risks are to the upside on that one. Well, apart from one factor, every single piece of anecdotal evidence says it's going to come in better than expected, whether it's all the employment indices of surveys, whether it's the ADP, whether it's the Fed's beige book, whether it's the claims reaching a 49-year low the week before last. So you actually then have to be somewhat cynical and say, well, surely it must. The market risk is clearly on the downside. But any proper assessment says it's not. But two things we're really looking at the moment are, first of all, average hourly earnings. There's been a lot of debate about whether last month's jump up to 2.9, which was the highest we've seen in this cycle, was actually a sign that we're starting to see some acceleration. And there's certainly plenty of evidence from, for instance, the beige book, that there are pressures building. However, there was an objection to last month insofar as it was artificially boosted by weather effects.
Yep.
So we've got that aspect, and that's certainly going to be critical to the market reaction to this data. But we've also got the unemployment rate. Now, that is forecast to fall to 4%. That is a new cyclical low, as we can see on the chart. And it also matches the low that we saw back in 2000. Okay. So impressive from that aspect.
Yeah, very much.
However, the other side of the coin is that would sort of generally indicate that we've got a very, very tight labour market and there's no slack left in it.
The textbooks would say that's full employment, right?
That is getting pretty close to full employment. However, one does have then to look at the underemployment rate now. The underemployment rate basically measures those who are doing basically fewer hours a week, or which then is full-time work, or are in a part-time job and would like to do a full-time job. Now that is still actually quite high relative to where we were back in 2000. Which was 7%. This is up at 8.1%. It had been improving for much of 2017, and then towards the end of the year it just ticked up slightly. So we need to see some improvement in that. If it does start to move markedly below the 8% level, yep, then that does put some extra pressure on the Fed, and that is probably the other key element other than wages today.
So what we're effectively saying is it looks as if we're near as damn it full employment, but we're not actually full employment in terms of working hours.
No, absolutely not. And that is probably one of the reasons why we've not got quite so much pressure on wages at the moment. So how does this all play out? Obviously, financial markets this week have been pushed backwards and forwards by Korean Peninsula tensions, by the whole trade tariff tensions. We seem to have better news on that towards the end of the week. There's a meeting between Kim Jong-un and President Trump. There is talk of denuclearization. And on the tariff front, there seems to be some exemptions being touted, which would make things perhaps not so bad. So we're in this situation when one looks, say, at the US 10-year yield, that we've been trading sideways, basically, since the middle of February, in part because people started allocating money towards the US 10-year after that very steep rise we saw. I mean, when one thinks we were at the beginning of January, we were 240, we almost got to 3%. So there was always going to be a bit of money to go in. The question now is this has this just been a consolidation period at higher levels? Because when one looks at the correction that we've had to that rally in long-dated yields, it's modest. It basically is just taking some of the steam out of the move. It was a little bit too fast. So today's data will actually be quite important on that front in deciding whether we actually continue with this rally, or we continue with the sideways churn, I think is probably more likely, or we go up to challenge that 3% level, at which point we need to have another discussion about what's become quite obvious, particularly over the last 10 days. Financial markets, they've been spooked by the tariffs, they've been spooked by the tensions in North Korea.
Yep.
But the buy the dip mentality is still very much there, and there's probably two good reasons for that. First of all, there is still that 17.4 trillion of central bank money knocking around the market. The ECB and the BOJ are very much carrying on, even if the ECB is getting towards the end of its but that's money still going into the market. And on top of that, we have the expectation that there's going to be in the regions of, say, $800 billion of share buybacks. That money all has to find a home somewhere. So the mentality of buy the dip is very much prevalent. However, if we then start really having another challenge of that 3% 10-year yield level, perhaps then we need to have a look at the risk premia that are in riskier assets, be that corporate bonds, high yield bonds. And it's notable that when you look at the fund flow data, there's still quite a lot of outflows going on. Last week was pretty much universal, obviously in response to the tariff move, but there were outflows from stock funds, about 10 billion. There were outflows of about 750 million from investment-grade bond funds, another half a billion from high yield, which has been seeing outflows pretty much all year long. So I think this is, it's probably a phony war truce that we've had, and that we're probably going into an interesting stage over the next couple of weeks and into the second quarter, where markets really do actually have to start looking at relative values between, above all, government bond yields, especially in the US, and the rest of the market, to see whether the asset allocation practices that they've had over the past 2 to 3 years, which has basically been a combination of path of least resistance investing and so-called FOMO, fear of missing out, whether they are going to be appropriate as we go forward. I suspect it's going to be proved to be a rather more challenging environment and for investors, and this quieter period that we've had is probably just a lull, and we go back to resuming battle as we were, particularly at the end of January, beginning of February, and get a slightly more volatile market.
On that note, Mark, we've run out of time. Thank you very much indeed for your soapbox thoughts. That's Marc Ostwald from ADMISI. Thank you.